Good morning, ladies and gentlemen. This is Clueless Trading Frank. This is it's a beautiful Sunday morning, October 16th, 2016, approximately 10:13 a.m. And this is an advanced coaching session for enrolled session members. People who have missed this, people who couldn't make it this morning, and I mean the ACS students can access this via private email link, and I'll put that in once this is uploaded a bit later on the day. But thank you for attending. So let me take a quick roll call. We have Corey, my friend here. We have Jules. We have Steve Gressett, I believe. We have Tom, Swimming the Market, and I believe that everyone has audio-visual connection with the screens, correct?
Yes.
Okay. All right. Getting straight to the point. The topic of this session is to basically explain some of the strategic tools. There is absolutely no way possible, humanly possible, for me to explain everything, but I try to do that as much as possible, as you all know. But to show some strategic tools, and in this particular case, visual representation of human emotions, known as charts, and all the different and many of the different ways of what I am looking at, right or wrong, as a trader, as an investor in the financial markets, I have to have an opinion. The minute I deviate from my opinion and start to question myself on every single little thing that happens, and that happens to all of us, we know that, we are doomed. Finished. It doesn't mean that your opinion is going to be right every single time at every single moment. But I do believe, from my life experience as a human being and as a trader, and then somebody who does this for a living, so it's not a matter of luxury for me, it's a matter of necessity. I try to fine-tune everything, fine-tune my brain in understanding what is going on, try as hard as possible to mitigate and rebuild up some of the tactical losses because of some emotional factors that come along the way and all that good stuff. The reality is I spent a good deal of time over the weekend looking at some longer term charts and some shorter term charts, but more so some of the more intermediate term charts, and making a determination what I think will happen as we get into the last leg of this uber volatile month, which is October. And I'm putting the roadmap, I'm sharing that with all of you, explaining as much as I can, my reasoning behind it, trying to keep a lot of the emotional tides that constantly flow through our head and get straight to the point. So saying all that, I do appreciate all of you being here this morning, and it shows serious commitment on your part. Couple of comments like I always start with. Number one, the volatility in the markets, and I call it structured volatility. It's not just random. It feels random on an intraday basis, but in reality, it's structured volatility is intense. And it doesn't matter whether everything's looking good on a technical setup, on a certain hour, within the next 15 minutes, it goes haywire. So the different ways one can handle this stuff. There is no method, okay? The most powerful way you can handle it, and I'm talking from my perspective, is to be mentally strong. And that, God honest, is the truth. We all try to basically look for all these different, what should I say, facets of, okay, if I do this, it's going to go right. If I do this, it's, if I do this, it's going to work. No, it doesn't work like that. The most important thing that you have to do, aside from having all the strategic tools in front of you, is to basically rely. And I'm talking from my perspective. Everyone has their own style and everyone can do what they need to do. From my perspective, is look for clues in the literal sense within these complex chart patterns, and not make any very long-term projections of what might happen, Because the reality is the long term in a trader's universe doesn't pay your bills. We don't know what's going to happen in December. Yes, we can make a projection. Of course, you can make a forecast. We don't know what's going to happen 3 weeks from now. What we do kind of can get a feel on is what might happen in the following week, in the following 10 days. And really that's what we are relegated to at this point in time. So when people make long-term projections, and that's fine, I make long-term projections too, but to use that as a tool for your trading P&L, in my opinion, doesn't serve any purpose whatsoever. It doesn't. Because the volatility in the market is so intense that what used to be long-term, and this is not just today, this has been happening for a couple of years now, is now compressed within a matter of hours, if not within a matter of days. And these patterns that you're looking at behind you, and the ones that I try to put my lines and my trend lines and stuff to make it a little bit more palatable and more more of a navigational guide, with all my trend lines and consolidation boxes and falling wedges and stuff like that, channels, is simply, in my opinion, is the only way that I can survive in dealing with these complex market patterns, which were non-existent. And I mean that, which were non-existent years and years ago. You can sit here and look at a pattern like this. Yes, the gurus will tell you, yes, it's a very large head and shoulder and blah, blah, blah. Well, if that was the case, then what happened here? What happened here? What happened here? Are these patterns that one could have forecasted and predicted? Right here said, okay, this is definitely going to happen. No. And the ones who do say that, I challenge them to really put a factual argument in front of me that they actually knew this was going to happen, other than an emotional bias that everything's going to fall apart or everything's just going to rise like hot air, on a blue sky, right? Other than those type of intense emotional biases that all of us go through, and I go through far less than I used to, believe me when I tell you that. And that's what I try to push upon people to understand. But aside from emotional biases, and then boom, you get lucky. Yes, I expected the market to come down, and yes, it exactly crashed 1,200 points in a day. It's all lies. You're just lying to yourself. And yes, you got lucky. Not you, but I'm talking in general, that it happened. So in between all that, let's try to be as rational as possible. A term which has been lost in trading, in investing, in politics, and in general in society. Okay? We're no longer rational beings. We are emotional beings driven from one side to another in all facets of our life, including trading. And that is my behavioral comment of what is exactly going on. People who keep a calm head are very few. People who get emotional because our brains are programmed that way to be manic depressive, to get out of control, feel great, the dopamine's kicking in, endorphins kicking in, right? The serotonin kicking in and all that stuff. Or at the same time, the opposite of that, which is depression. Like, oh my God. Now, we go through many bits of that every single day in the market, intraday markets. And that is reflected and manifested, nothing wrong with that, in the comments of traders, investors, including myself. So please, what you guys all need to do, you're all adults, and you're all very smart in your own professions of what you do. That's for sure. I've talked to many of you I know. Is try to keep as balanced as possible. Don't lose your head because the prices are moving at the speed of light on stocks that you own, on SPX or RUT or index calls or puts that you might be positioned in. And the minute you do whatever you do based on your emotional deficiency, and that's what I'm going to call it, and my emotional deficiency for that matter, you will be wrong. Case in point, I expected from what I saw on this particular move that the market should at least hit 2100, if not 2090. I was dead wrong. Okay, and that element of my portfolio, which was involved in trying to keep up with my emotional stubbornness. Gotta keep on buying, gotta cost average those puts down and everything, and the feeling overall was so negative, and I was looking for just a 10-20 point move lower, which for all I know I might get. But you know what? I'm talking about what happened. Cost me money. So how do you get around it? Very simple. Did I put my whole net worth into those SPX the cheap lotto type puts? Or in some cases they weren't lotto? No. So my losses were painful, but they were tolerable and made back up in many instances on other trading alerts that I was putting through. Whether it be Apple, whether it be Tesla on a quick overnight trade where they were up 70, 80%. Whether it be Buffalo Wild, BWLD. Whether it be AutoZone. Huge ramp up, took some beautiful profits. And then the stock pulled back as the market basically became super volatile overall. So what it comes down to, and these are the two words, you have to be you have to be flexible, and you have to adapt to the circumstances. I do realize, but that's really not my concern, to be honest with you. But I do realize fully, because a part of me, I guess, in between the tough guy image does care, okay, is that people don't always have the flexibility to move it in and out as they would wish to. But that's something you'll have to deal with it on your own. That's nothing I can do to help you. So saying all that, if people, so you have to be flexible, you have to be adaptable, and you have to be ready to change your overall strategic mindset, not emotional mindset, but you change your strategic mindset on whether or not you're going to want to go long and short on the same stock that you might have been long on. Turn around, short it. It doesn't matter. They're numbers which you need to attack so that they work in your favor. And then you just got to, luck is an element of trading, just like anything else in life. The fact we don't get hit by a crazy driver on the road, that's a matter of luck. They're crossing a busy street. So luck is an element. Technicals, fundamentals, and all the stuff that we analyze to make to make money are not the complete picture, obviously. So saying all that, get ready for some volatility. We are ready for volatility. We go through it all that. So it's kind of stupid of me even saying that. We have seen intense volatility, and now we're going to get into some charts, and we're going to look what I'm looking at, and we're going to make a determination, what you need to do. Saying all that, we are in the middle of earnings season, and we're going to see some powerful earnings winners, and even non-powerful earnings winners, which go up $1, and the options go up 120%. And I've never really even, and I think this is my second time that I've actually traded CSX, and cheap calls at 60 cents, 62 cents, they went to $1.40. Yes, I didn't hold it all the way up there. I was out mostly around the dollar level or so. So what? That was money in the bank. So one of the key things before we get in the charts that I need to remind everyone, stop making excuses. And that's something I tell myself. Start making excuses to yourself and justifying your emotional deficiencies. You ain't going to get anywhere in life. Well, I shouldn't preach to anyone. You guys are, are grown people. But at least in trading, you're not going to get anywhere, period. What losses might have been made on certain factors because of so many different risk factors in the market, you need to make that up. That's how you got to get into Monday morning. You don't get into Monday morning thinking, oh boy, am I going to buy something because I'm going to lose less? Or are you going to tell yourself, I'm going to buy this because I want to make a crap load of money on it? I know it sounds childish, but that's the way you got to program your brains. You go in with a winning mentality on a trade, chances are you'll win, or at least you'll minimize your losses and do what you need to do to make that money up. You go in with an attitude, and believe me, you all know that better than I do. You go in with an attitude, oh boy, I gotta trade this stock, looking over my back every 2 seconds, and I hope I don't lose 40-50% of my trade on fast moving options trades. Obviously, you're not gonna win. You're going to lose that, because the minute something clicks backwards, which it does every second, you're going to lose. Did multiple SPX trades on Friday. You know how difficult it was? What is that? Every minute that I bought it, it went up the second minute. Yeah, it went up a little bit. Then it backed off, stayed the range, and it was a super volatile, especially on an intraday basis, on the back and forths that I was doing. And I came out 3-3, and I have a couple of calls going into Monday, which I'm slightly down on. Big deal. So the bottom line is that you start to go in with a warrior mentality to do the right thing. You're going to come out ahead. You keep on trading this market with huge amounts of trepidation and fear. Don't trade this market. So saying all that, we're in earnings season. We're going to start to see a slew of earnings coming through, and I'm compiling a list later in the day of the choice ones that we'll be looking at, and one step at a time. I'm not going to get into the earnings strategy play. We'll do that during the week sometime. There is actually no strategy play on earnings. You just got to basically, you can do straddles, you can go straight out options on small lots, you can buy a few little commons so you can get out of it on after hours, up or down, sleep well, say, hey, I just made a little bit of money, and you got to play with small amounts. If you do not participate in major earnings movers, okay, and there's going to be quite a few of them, and we know the big names, obviously, the Apples, the Pricelines, the Netflix is coming on Monday. Earnings is a gamble. It's a calculated gamble. You got to figure out, okay, I'm willing to lose this, or this is what I'm thinking. I'm going with my gut on this, and I'm going to play it a little bit. Because if it moves, it's going to move big, and you got to figure it out. But if you don't participate in it, then don't do it. There are a lot of people who don't play earnings. Fine. I played earnings for a long time. I would say a majority of them have been huge winners. And I love it. Sometimes I buy deep in the money. Anyway, I don't want to get into the earnings aspect of it right now. So let's start off with my first chart here. Actually, let's start off different. Let's start off by looking at a couple of other charts that I look at, among many. And 1 second here. Trying to drag this screen in there. And bingo. So let's start off with a chart that I've been tracking for, I track it all the time. It's not the most, it is the most reliable when it comes to actual swing trading. It gives me a slightly good vision of what might happen on a swing basis over the next, let's say, week or 10 days. Okay? Because this is a daily version of it. And I don't rely on any one particular thing, but let me tell you how I'm reading this so you all can understand, some of the things that I'm looking at. So, hi Exita. So, yeah. All right. So let's kick off with this here. This is I call it the Swing 533 chart. This was sent to me by a friend of mine many years ago. And some of you who have done the ACS sessions with me, I have gone through it in detail. It's not the most complicated chart. Just you have to keep an eye on a couple of things, and hopefully they line up and they go. But from a swing perspective, I've shown this several times, and I'll show this again. Let me try to make it larger if I can. Okay, that's a little bit bigger. Let me get a little pen here. So this is the simplest way of reading it. This is how I teach. This I would teach somebody who is a completely non-technical person. You got these stochastic lines here. When they start turning, you will get a short or intermediate term bounce. These are the types of markets that levels are, as we all know, levels are being hit on the upside and downside very rapidly. So I would say that this would be a max of a 5 to 7 day kind of look what might happen. But if those levels are reached, and that's a very critical factor in technical trading. Some people ask me, what's your time frame? Okay, I have no idea what my time frame is, because in the old days I could actually make a projected time frame that, okay, Chipotle is going to hit 400, then it's going to jump to 450. The time frame could be 2 weeks. Now it can happen in 3 days, both on the upside and the downside. So the time frames are, to me, the time frames are exactly when they hit those technical levels. That's it. When exactly they'll hit the technical levels, ask Mr. Volatility about that. Ask the machines who control the market. If they want to run the market up 200 points and it hits within 4 hours, well, be it that way. That means the time frame has been reached and the levels have been reached. So wherever the technical levels hit on the overbought, oversold side primarily is where what the time frame is. And you know better than I do. You all know better than I do. That's exactly what's been going on. So there's no, so that's it. So, so saying that it doesn't happen in 1 minute, let's call it within the day, within a couple of days or so. Number one, every time you see a, these are the candles. Obviously, we know that red candles and the white hollow ones are obviously the green candles. Every time the stochastics turn, the market has a reasonable bounce. Period. The bounce can last with a day. The bounce can last a couple of days. But from a swing chart standpoint, I'd say this week. How about that? So look carefully about what's there. And if you're looking at a larger screen, then obviously you can see this better. Stochastics turn, the markets rally. So here we are starting to see the first signs of a curl, a move up. Not a crossover yet, but a move up on the stows, right there. Same thing happened here during the big Brexit. What do you call it? This is? I'm sorry. There have been so many of these very large movements up and down. So this was Brexit. My apologies. This was Brexit. So this was the early September crash in the market, the one that resolved itself into a triangle. Just to remind people, shot up, came down, and now is in this phase here of a, it's actually not a full triangle, but yes, right there. So this chart, I'm going to, obviously, I have in other platforms where you can see it more clearly. Whichever the case, we broke below the triangle, massive reversal hammer, and now we are right here. Okay, a black doji is I don't have the exact interpretation of that, but from my experiential, from an experience standpoint, it's a real long word. Off the lows, off a reversal hammer, a black doji is a constructive format. It happened here, right after Brexit. It happened here, right before we had the monster breakout. Okay. I believe that was a Fed breakout, and now it's happening here. Let's go back before I deviate further on how to read this swing 533 when I show it. When the stochastics start turning, and especially when they cross over, that means you got to stay long on the long side on your long positions. Now, the market is very bifurcated. Different sectors are moving different ways. This I'm clearly talking about from a market standpoint. This being the S&P 500. Period. All right, so that's good. So if somebody wants to play the clean SPX or the RUT, this is the most effective chart out there. Because nowadays, market could be up 200, 300, and some individual stocks won't be even doing anything. We know that, or down. Try to make, head or tail out of it. Most of the times you won't be able to. Saying all that, every single time you had a stochastic crossover from mid-level, right? You've had short, quick 1 or 2 day type of rallies which have given in. When you have had it from the lower level, and you just use visual metrics here, when you have had it from lower levels, right? This was the big Brexit one. They have lasted for multiple days. Simple as that. The deeper oversold that you get into, deeper oversold that you can get into, then obviously the better it is. So that brings us to the RSI component of the swing 533. We are in deep oversold territory right there. You can see that. What happens every time that we go in there? Every single time, and this was deep oversold, right around before Brexit and after Brexit. Before the run-up, prior to Brexit and after Brexit. So every time you get down here, you rally. That doesn't mean that it can't just kind of pull your hair out during the day, and as we are all in one way or form monkeys on hot tin roofs when we're looking at prices flashing in front of our screens and seeing our P&L dance like wild maniacs, you know, in the red, in the green, in the red, in the green. Let's try to stay calm. Here we are, one way or the other. This will resolve as it in the overbought condition sometime this week. Once it gets up here, obviously things start to, you know, things start to get a little frothy. Now, just because it gets up above the 90 level, okay, that's when it gets serious overbought on the 533, doesn't mean you're just going to immediately run down. We know overbought conditions can sustain themselves for a good 24 hours before they give in. We know that. And that's very hard to go out there, put out some shorts out there in the form of the index puts, and then see them lose value a bit, yet you know that things are overbought, and you're wondering, why is it not coming that way? Because the market doesn't move on our time. If there is a serious amount of shorts in the market, which I believe is exactly what happened during the time that I lost money, and some of you did too, on the SPX puts, okay? And I have no regret saying that. I take strength in the fact that I learned something about not getting emotionally stubborn like many traders are, many in our group are, okay? And not looking at the fact that we had the slow stochastics and the fast stochastics pointing higher in the midst of severe volatility. I questioned it. I didn't do it. Boom, I got punished. Good for me. Made it up in many different fronts, but still, gotta follow the technicals. So the point is that here we are, stochastics are starting to do that. Let's see what happens. If they start to curl down again and create a double bottom, then we'll see what happens. But in the meantime, the quickest way to read the swing 533, oversold conditions, stove starting to turn, and here is the other interesting part that I found as a major positive divergence. And by now, many of you should know very well what a positive divergence is. It's when prices get down to the same levels or get up to the same levels, but the internals don't match it. So here we are back to the September 8th, September 9th lows in that 2120 level in the market, right? Look at what had happened to the MACD. The MACD was severe oversold at about -7.5. We went down below the September 8th level for a quick second before we had the big hammer reversal. But look what happened to the MACD. The MACD was only down 2.5. What does that tell you? It's telling you that they have a positive divergence going on here. The positive divergence on the markets do play out every single time, but they are not going to play out exactly at our time. So we have to be flexible. So if the positive divergence was playing out here too, by the way, on the what do you call it? Right during Brexit, it was starting to go up, but there was heavy volatility. We went lower, but the bars were getting smaller, and then came the monster rally, which 90% of traders missed. I know it. We didn't. We caught a good portions of these moves. Anyway, that's the past. We're talking about what we can do now. So there's a positive divergence playing out here, which I am noticing, and that's telling me something. Because with the same price levels or below, we went below September 8 levels. Yet the markets internals did not confirm that. and that's a good thing. Oversold, starting to turn, and a positive divergence here. So that's my read on the swing 533. NYMO. I know a lot of you look at the McClellan oscillator. This is, I certainly do. So let's take a look at what's happening in the NYMO. I like what I see. Deep oversold readings. Every time we get down towards these levels, and again, let's not be complete number crunches here. Just look at it visually. Look what's happening here. Look what's happening here. Look what happened here. I mean, what happened here? What happened here? Look at, see. Every time the McClellan oscillator, let me see if I can get this larger. Okay, that's better. Let's get these out. Let's get, okay. Look at from all these levels. What happens? You get a deep oversold bounce. We're tactical traders. We're looking for oversold bounces or from overbought levels, oversold resets. Resets down, bounces up to reset the indicator, again, back to overbought territory. So saying all that, this is pretty clear to me. It's clear as day to me. Doesn't mean I'm, we're not going to get another cataclysmic event that's going to drive the markets down another 400 points, but I'm just going with the tools that we have in front of us. You get overbought here. These are the Bollingers. What I do with the McClellan oscillator, the dollar NYMO, is I put my own parameters over it, right? I transpose my thing. So I use the simple moving average. I use that's in blue, the 50 moving average. That's right here, this blue line. Then I use the Bollinger Bands to give me a visual indication of where we are within the frame, within the large trading band that we're trading in. And I use the pivot points, which allows me to give me a numerical representation on support levels, S1, you can see that, pivot, resistance 1, resistance 2. So once I put those things over, and then on the lower level, I put the RSI. I mean, then there is the RSI on top. Then you have the MACD, which is this, and then I use the ADX line, which is the vortex indicator, really, the DI, positive DI directional indicator and negative directional indicator. Now, it's not rocket science, but this is how it works. So here we are. This is looking good to me. At least, in my opinion, we are negative 50 almost on the McClellan oscillator on the daily. At least from my vantage point, yes, we can kind of mess around down here a bit, maybe for a couple of hours, maybe for a day, but we will, in my opinion, and I stand by it, it's my opinion, that we are going to move up at least to kiss the 50 moving average on the McClellan oscillator somewhere here, or at least try to go positive. And we get an overshoot like that. An overshoot like that means the market's going to rally 400 points from here. Of course, when you get an overshoot like that, don't start getting excited. That's the time that you want to sell your tactical trading positions and lessen your long exposure. But this is the point exactly, as you all know, when the retail investor gets all excited. But at this point, excitement level is 0. I know it. I feel it. And that I like. The excitement level in the market, despite multiple winning trades, individual stock alerts and stuff like that, people generally are very morose, and it just overall, there's a feeling of gloom. I like that. You don't need feelings of euphoria. All right? You don't. To make real money, you need feelings of gloom. And that's exactly what's going on right now. So saying all that, this is good. I like it. Deep oversold. Starting to see You know, it's a pattern. It's a pattern. Every time we get down here, of course, minus 61 would be fantastic. That's when you buy with both hands down. Back in Brexit, it was minus 55. We're at minus 50. I'll take it. Then we have the MACD, which is kind of flat. I'd like to see it turn up, but the minute this turns up, that's when it drags up the MACD lines, and then it starts to cross over. It starts to cross over. And so the MACD is dependent on, as we see the oscillators, you know, get back towards somewhat of a neutral level or overbought level. Is it possible that we overshoot and we go, you know, we hit the upper end of the Bollinger on the McLaren oscillator? Absolutely possible. It's happened so many times. But at least it's going to bounce. That to me is good enough to make some money. The ADX indicator, you can start to see it's not the most important one on this particular thing, but you're starting to see and I'll show you on the other chart because we can see that well here. It's starting to turn up from the bottom, the green line, and the red line looks like it wants to basically come down. And that, as you all know, is the first signs of first early signals of a possible quick, sharp market bounce. When the green line starts to edge up like this, talked about this before, and the red line, imagine this to be red, basically crosses down. Right at that point of crossover is point of maximum opportunity. That's when the market surges. Okay, and that's how the ADX line works. These are all momentum indicators. So saying all that, let's look at the RSI. The RSI is kind of going flat, and the RSI right now is at 44. Of course, RSI go close on the swing on the NYMO, close to the 30 level would be a screaming buying opportunity, but we are pretty much on the lower level. You can see that. We are not overbought. We are not close to that 70 level. In the case of the NYMO, the way they set their RSI 14 is that it's not 90. It closes any, you know, you start to see it going close to 70. That means the market's going to sell off. And we're not there. We're at 40s. I'll take that. Net, it's neutral to positive bias. So NYMO, I like. This is the most important thing that you look at on the NYMO. Where are we in the context of the trading band? Are we overbought in this zone, or are we oversold in this zone? We're obviously oversold in that zone, and that's a plus. Let's move on. Let's take a look at S&P bullish percentage index. Many of you probably do, right? Many of you probably do. I love what I see here. This is probably, from a swing perspective, one of the most reliable indicator. There has been such a drubbing in the market, right? We're long S&P calls. The China numbers comes out. Their exports are down 10%. I mean, it was just like, boom. That's the day the market crashed, right? Thursday. And then we had that hammer reversal. So what happens the next day? China CPI number comes out, Consumer Price Index, showing a higher number. So what's going on? They're showing that nobody's buying anything, yet prices are moving higher. So the market basically picks up on that and opens up big and starts running. So I'm not going to get into the nitty-gritty of that, but the bottom line is that the numbers can play upon the markets in a big way, but they can also switch in a second. So let's look to see. That's why I rely on technical so much. And believe me, I know a lot more about fundamentals and macroeconomic stuff than most people out there. And I'm not showing off. I'm just telling you a fact. But I realize that mixing in both and relying on technicals pays my bills a lot more than if I'm sitting there trying to overanalyze, you know, the market fundamental situations. There's always going to be max bears telling us that we are finished, and the max bulls who are actually there are no max bulls right now. There are bullish traders, there are bullish analysts, but this is my saying, okay, and you know that bulls are talking the talk, but not walking the walk. You guys all know that, okay? And the bears are growling because they're getting some chances here and there of making some nice money, but they're scared too. They're scared shit. Okay. So because the market is spiking up on technical levels and where we are right now, which we'll look at the other charts. So look at the bullish percentage index. We are down here. This was Brexit. The bullish percentage index during Brexit went to about 17. We're almost 16. So what happens every single time that the bullish percentage index dips below 30? The markets rally. Now, it doesn't mean it can't fall a little bit more or move sideways a little bit more, but I'm giving you a intermediate term swing perspective. You got a bullish percentage index down here. Yes, intraday, you can do some quick scalps on the short side. You try to keep a lot of shorts overnight, they're going to murder you. And look at this, and look at this here. It's hugging the lower Bollinger. It's hugging the lower Bollinger, and it will snap back. The bullish percentage index will at least climb over 30. These are extreme levels. Extreme levels. Back in April and May, when we were setting highs on the market, look where the bullish percentage index was going. It was well above 70. The correction was due. And it happened first, pulled up again a little bit. That was the rally right before Brexit. And then this happened. So right now we're back in that deep zone. Got to take these things into account. Doesn't matter what our feelings are. Here, the same story on the ADX. Severe overbought on the negative directional indicator, the negative DI, and severe oversold. You can see that on the positive directional indicator. What happened the last time this happened? Because Brexit is our closest comparison to what's going on. No, actually September is the closest comparison to what's going on. But still, I'm looking at a big sort of event type of scenario. We got down here. Look what happened after that. So one with the other, I'm not saying it's going to cross over and we're going to have a 1,000-point rally. You know, that's not in my vocabulary. I'm just talking about tactical trading. Is at least the green line here will start to ease up, and the red negative directional indicator is going to start to move down. Because in my opinion, of course, we have to be flexible. The bulk of the damage has been done. And we saw that in the form of the bullish percentage index on the SPX, the previous chart. That's something that opened my eyes, because I don't look at that every day. I look at that every week. I'm like, wow. And so once this even starts to curl up a little bit, you're going to get powerful tactical rallies, which will last maybe an hour, 2 hours, maybe a day. Because you know how it is. You got some nice profits. You better manage your profits or they'll take it away in 2 seconds. All right. So now we're out of that. So we covered, just in quick summary, we covered the swing 533, looking good so far. Just remind everyone again. I like this. I like this. I'm liking what I'm seeing. And tactically, let's hope that this thing crosses over, and then you get a powerful swing. I like this. Last time it was down here. I like that. I like that. So those are positive. I also like this positive divergence because this was way oversold at the same levels that the market was in last time. We kind of came down below those levels, and the MACD indicator didn't even come close to it. That means that the hit that hit the market wasn't that there was the smart money didn't just completely panic and sell everything. But we did hit some major critical indicators, as we know that day when the market fell apart. We had a 9-to-1 down day. We had all 11 sectors down. We had the McClellan oscillators at minus 700. And lo and behold, the markets snapped back. Okay. NIMO, explained it to you. I'm liking what I see so far. Very nice. We could slip a little bit more, but remember, even during the most cataclysmic times in the market, we do not go below these levels here. Below 67 is an outlier. You see minus 67 on the NIMO at the end at the end of closing, end of the day's printed numbers. You want to buy with both hands down. Those are like those are the perfect moments to have tactical longs. All right, minus 55, good enough. Minus 50, getting there. I think we're close. Minus 61, the perfect moments. You want to know perfect moments? Those are perfect moments, all right? Because you will get a 24 to 48 hour bounce, which will last maybe 6 to 7 hours. It'll happen within the next 24 to 48 hours. So you got to be somehow a little bit predictive and a little bit ahead of the game, which reminds me to mention one comment. This is such a difficult, volatile market that if you're not a little step, even a teeny weeny little step ahead of the game, you're not going to make money. So some of the other grit your teeth, say, okay, this is my, I'm going to make up a word, okay? I'll be Sarah Palin for a second. I'll just make up a word, riskable. You like that? It's a good word, right? We'll put that in the dictionary, riskable. So you say, this is my riskable money, and I'm going to go in there with that because I want to make 100% on that. Who knows, within the next hour or the next day, whatever the case. So that's your risk quantification, for a better choice of words. Then we looked at this, explained to you what I'm seeing, and I like what I'm seeing. This is not something that happens every day, so we have to take advantage of it. Now, can this go lower? Absolutely, absolutely. But what I'm saying is that during the times of the Brexit crisis, which in my opinion was a real existential crisis on financial markets, mind you, and I really thought we were going to go lower. Really thought it was going to go lower because nothing I could fundamentally justify. Brexit, come on. And it's like the U.S. unilaterally declaring they're going to cut, they're going to abrogate and cancel every single trade agreement they have with all major trading partners in the world. U.S. economy the markets would drop 3,000 points in 2 minutes. I don't care what anybody tells me. And then they continue to fall another 3,000 points if the U.S. ever does that. Of course, U.S. corporations at that point won't allow it to happen. Well, what can they do if it happens? But it'll be massive, cataclysmic. That will be Armageddon, ladies and gentlemen. All right? So Brexit felt like that. And because the world is all intertwined. So you just can't cut off one arm and say, oh, I'm going to go partying with the other left arm, Nah. You're going to bleed to death. I know it sounds harsh, but that's the way it is. Okay? We are all intertwined. When it comes to global business, I'm talking about. I don't care whoever's political thoughts are and stuff. That's not what I'm getting at. I'm talking from a financial matrix that we live in. We're all intertwined. So Brexit felt like, okay, the matrix was broken a bit. But now, so I just wanted to say this before we leave this set of charts, okay, is somebody might say, hey, look, this is looking very familiar to what is happening here, at least from a standpoint of thing. I noticed that too. For this to happen, where it would be a 900 to 1,000 point drop, we need to, I don't know this, okay? I know as much, maybe a little bit more, but if there is something fundamentally flawed, and I mean that fundamentally flawed within the credit markets, then we will get one of these 900, and that's an outlier, but I'm just mentioning, type of drop like we saw here. Otherwise, we'll bounce. If any one of the companies, we have a slew of companies, General Electric and all these guys coming out, what if somebody just completely loses their head, gets real emotional on their conference call and say, that's it, we don't see any growth anywhere, the world is finished? We're going to get one of these. So I'm not kidding around, but I'm just simply saying that if we get an outlier event like that, obviously you want to get the heck out of Dodge, and then you will see the inevitable bounce. So again, just letting you guys know, if there's a black swan event out there somewhere, then we are going to see a large drop between now and the end of the month. I doubt it, but just mentioning it to people. Saying all that, there's always risks in the market. So let's hit the charts that we normally hit, all right? Boy, okay. So let's look at this one. This is freeze again. Oh, come on. The script business is really annoying. Hold on. Stop plugin. Okay. Okay. So this is very clean looking. And here you have the huge double bottom lows back in February of 2016. And this is where we are right now. I drew these lines the other day. I put the chart up there. You can see it. So it's just a visual representation of what's going on. All right. So what do I see? We tried to, we were up at, and these are the futures, by the way. You can see the spike. Let me close in. So here's your January lows. Perfect uptrend line. Perfect uptrend line, right? This one. We close right above the uptrend line with a minor green doji. I'll take that. I'll take that. Here's your Brexit. And believe me, I know that most people don't like to believe this. Markets are purely mathematical beings. And of course, everything else comes in below that, right? There's no way these structures would be where I could have drawn these type of technical structure over the market pattern if the markets weren't mathematical. No way I would have done that. No way. There would be just like wild, crazy, like, you know, I used to call it the drunken serpent, you know, I make up funny names once in a while. I had a Vietnamese thatched roof pattern, which was basically like that. And then the dragon formation where, you know, and then I had the galloping horse. I know thing reminds that. What do you call? Jules, I'll answer questions in a second. That's a good question. So the galloping horse pattern and all that stuff. And so I know that Swimming the Market remembers that stuff from the old days. I still put it. What did I put the other day? Some other funny ones. But you know what? They actually look like that. So look at this here. So this is where we are. What I like is simple. This is what I'm going through my stupid simple head. We're the lower end of the Bollinger. That's exactly where we're resting. It closed right above the downtrend line from all the way down here from the January lows. We have deep oversold conditions right here. I'll take that. Yes, it might dilly-dally around a little bit here for a couple of hours, for a day, but that is, you know, that is certainly deep oversold conditions on the regular stows. We are resting at the low Bollinger. I'll take that. The only way, unless we have a black swan event, I repeat, and I don't know, what is a black swan event? You can't quantify it, so we don't know. So if there's a black swan event and the Bollingers go like this, whoop, curl down just like that, fast, only then all bets are off. You go short, thump, 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 thump. At that point, we are going to hit. We're going to just fall hard below 2060. That's only if the Bollingers curl down really hard. Ain't happening so far. So why should I, you know, I'm just showing you the probability. I mean, the scenario that if that happens, lower Bollinger, above the uptrend line, and I'm not asking for the moon. All I'm simply saying, oversold, is that this is a constructive, technical format of a finish to a very volatile market on Friday. I mean, this week, this past week. I'll take that. Bullish reversal hammer. Cannot just write it off. This is the one that I didn't act on the long side With individual stocks I did, but not with SPX calls. Huge money left on the table. I am a royal idiot for that. And I know some of you guys did that, and good for you. You see a reversal hammer of this magnitude, you cannot sit there being stubborn, which I was in this instance, and saying, yeah, I'm going to keep on, cost averaging down on the thing. And the market, Mr. Market, hit me on the back of the head with a bat. All right? So the point is, you see a reversal hammer of this magnitude, I repeat that, you gotta act on it, period. If this candle closed on Friday like this, sorry, it was a and it was a inverted hammer, ladies and gentlemen, I would not be making up stories. That would be negative. If this was an inverted hammer which went below 50% of this reversal candle, it would not be good. But it's not. It basically came, if you take out these tails, it basically closed at the, the bodies of both the candles were exactly the same level. End of story. So this one is a daily, and it's a-okay with me so far, what I'm seeing. If we get a Bollinger bounce, we are going to go, and this is of a pinch Bollinger. You can kind of see that, right? If we and the Bollingers don't crash down and bend and curl downwards, most we're going to get is around 2172 on the real power move, 2172 on the E-minis, which, as you know, add 6 or 7 points to it, roughly about 2178 or 2178. I'm sorry, around 2178 on the S&P 500. That's a long way off from here. That's 60 points from here. That's a lot. That's about 350 to 400 points on the Dow. But this I like so far. Okay. Let's take a look at this, another representation of the same thing. And remember, every chart and this is just the way I do things, every chart kind of gives me a slightly different outlook. Yeah, this is brighter. It's got a black background, and it's a little bit more flashy. My good friend Swimming the Market's daughter loves this particular one better than those just, white background ones, and then she's probably a much smarter trader than all of us. So it's all there. So what do I see here? We have here you can see the reversal hammer very pronounced. Bollingers are these, right? Bollingers are this. And these two wide, the green lines, that's the wide range, that's the way it should be, is your acceleration band. Those are the points of maximum acceleration, up or down. I'm not even going there. I'm simply sticking to, like I said, SPX 2180, just like I explained on the, 2 minutes ago. And on the lower end, you got about 21. The lower end of the Bollinger is around 2127. If we break below, it's pretty obvious. If we break below this line, if we break below, let's say 2111, right here, the acceleration band, you got some nice downside coming. Not the end of the world, a couple of 100 points fast. But this is where we are. We have a pinch Bollinger. The market tried to enter on Friday, tried to enter and touch the this uptrend line. This is the uptrend line from the September lows. And all this really has meaning, believe me. I'm not just making this up. It tried to enter that, you see that, but then it closed below. There was a major resistance here at the 100-day moving average and the downward sloping 5-day moving average. Brings me to answering Jules's terrific question. What about these hedge funds getting out of stocks? Jules, that is exactly why there was selling pressure on the markets. So the hedge funds are getting out of stocks, and I mean some of them are, okay? And the more they get the heck out of stocks, the better off we are. I've been doing this for a long time. When I see headlines like that, it is generally a short-term capitulative bottom. So Jules asked, just so you guys might not know, she asked, what about all these hedge funds getting margin calls? Margin calls. Of course. Why do you think there's so much pressure on the markets? You think the market couldn't have risen 200 points on Friday? Absolutely. But there were margin calls that needed to be settled because margin clerks, institutional margin clerks, do not like leaving unsettled margin calls on their books. They want to settle them going into a Monday. That's the reason why we saw the last, look, we were up 84 points and we closed up 40 points. To me, that's when the last of those margin calls were sold. I'm not saying there's no smattering of other institutional margin calls out there. I mean, that's stupid of me to say that. Of course there are. But I'm saying the bulk of the institutional margin calls were settled. That's the reason why you get so much volatility between 3:30 and 4 p.m. on a Friday afternoon, or any other day for that matter, after a big drop in the market. Saying all that, I've explained to you what the downside can be. But in my opinion, hedge funds have been the worst performers in the U.S. financial market since 2009. They have been overall consistently shorting the market and bearish and getting their you-know-what handed to them. There are smart hedge funds who are beating the market big time, but they're a minority. Sitting there, singing the tune of Armageddon doesn't pay the fat bills of a free spending hedge fund guys. A lot of them are a bunch of idiots. I know a lot of them. Okay? They are not the masters of the universe anymore. The machines are the masters of the universe. And a lot of the quant shops that run the algo high frequency trading machines are not even hedge funds. They are pure institutional firms that are running these machines. So when hedge funds are basically shorting Apple at 80 and getting their butts handed to them on burnt toast, you tell me. You know what the 2020 thing is, right? 220. They take 2% of your assets, regardless of if they're making money. So a big shot, let's say, has $20 million with them. They're taking $40,000. I mean, yeah, $40,000 of, no, 2% of 20 million is, what is 2% of 20 million? I should want to know. 1 second. 0.02. They're taking, yeah, I was right. 40,000. They're taking 40,000 in fees for doing nothing. And if they made you money, they're going to take 20% of the profits. Whoopee. Great. It's the stupidest fee structure ever, but very lucrative during the days that they knew what the heck they were doing. So now that's why a lot of hedge funds, as you know, Jules, are a lot of hedge funds are basically cutting fees. And I hope they cut fees like big time to attract business, because a lot of people are very dissatisfied, and I'm talking big pension funds who invest in these hedge funds and stuff. They are not the masters of the universe, all right? Net, our overall performance has beaten the hedge funds by miles. Anyway, I don't want to get in there. So yes, it's good that they are exiting stocks, because the less, remember, markets rise when you have the most minimal participation in stocks. When you have the most minimal participation in stocks is when markets have sizable bounces. I'm a tactical trader. I'm looking for bounces to short or go long. I am not sitting here giving some long-term forecast of whether or not we're going to be at Dow 20,000 next year or what we're going to do December. I know it's volatile. I did call it to the teeth, at least from a macro basis, that the middle of the month is where most of the volatility happens. We have crossed over the middle of the month almost. Tomorrow's the 17th. And that's just the way it works. That's just the way it works. So, 1 second. So, Tom here asked me, okay, so this chart again is pretty clear. Well, not that clear, but clear. I like what I'm seeing here. Okay, this is good. any type of bounce. And remember, the bounce doesn't have to be a straight line up. It can zigzag around as long as it's going, as long as it's a rounded bottom and moving higher, just the way it did here. If you played this like we did, played this reasonably well, in fact, very well at the latter part, you get a big bang for your buck. But you got to set yourself up during those volatile days. And grit your teeth and keep on looking at the technicals and saying, okay, I'm sticking to it because the stochastics and the other internals are moving higher. Being monkey on a hot tin roof during minor volatility days is not going to pay any bills, because what happens is when you're chasing it up here, you make maybe you make a little profit, and then boom, the market comes down and you're like, oh man. And this traders do all the time. Good for them. I mean, if you want to keep on doing the same mistakes, that's fine. So what I'm saying is we've got to keep on watching this. If this thing is it's not rocket science. If this is starting to curl up in between volatility, meaning, you know, zigzagging like that, you know, that's it. I'm going to stay long. And of course, this is just one factor. And then we'll see what happens. My thing is very simple. I think we retest the 50 and the 34-day moving average, which also is the confluence of this consolidation triangle, somewhere in the short term between 2150 and 2160. And then I'll reevaluate my position. What happens after that? A person who's a uber bull will say, and I don't subscribe to that, it will say, hey, this is a definitively a fantastic W formation or a dragon bullish. Maybe it is. But I do know that this 50 and the 34-day moving average, which is crossed down, but still moving sideways kind of, is going to act as major resistance. So one of our good members asked me, this crossed down, so why are we even going long? Well, because we're having 200-point tactical bounces in the market. That the most recent one, I didn't participate in. And that person said, you know, I can't go long if this is crossed down. I said, great, keep on looking at a long-term chart and sitting there making no money. That's your thing, not mine. So in between the markets testing the moving averages and reversal hammers and going back in the Bollinger and stuff, tactical traders make money. A guy singing and dancing and saying, okay, you know, this thing is definitely going to keep on going down. It's going to be a long-term bear market. Good. So in the meantime, you keep on shorting like I did for 2 days. Okay? You're going to come up with a big fat egg called zero. Not just zero, losing money. So that's the answer to my question. And I'm sure that person's going to be, you know, it was a good question asked. Like, you know, so you can't be looking at this negative crossover, which is certainly a negative crossover. This is on a daily basis. But look how many days markets, even after this crossover, had 300-point rallies. That's what I want to get. This is good. And the ADX line here, which is the vortex indicator, is starting to show some sense of life. Look at that. The green line is moving up, and that I like. The minute the red line crosses below the green line, like it does here, in this case, let me try to find the case where it did. Here, right here, where the red line, negative vortex indicator, crossed below that, you get big fat rallies. I mean, this was a big fat rally back in May of 2016. Okay? And if it accelerates, we'll see. It hasn't crossed over yet. It's about to kiss each other. Right? Right there. So I'm watching this too. Crosses down. You will go along. Whatever the case, let's make this simple. I still think the retest of the 3450 is on the table. Now, my good friend, Mr. Gans, who's been known me for years, wants to meet Mr. Kopak, which I've shown before. So let me show Mr. Kopak if I have it here. The Kopak curve, and please read the definitions of Kopak and what it is back in on Investopedia. Okay, I'm not going to go into the MACD here. So let me get the Kopak curve out. Add indicator, my indicators. Kopak. So what is Mr. Kopak saying on the daily? On the daily, Mr. Coppock is basically now pointing down to negative 1.07. Now, generally speaking, what you do get here, one second, this is a daily chart, obviously, that in order for the market to have this is my read in the Coppock, okay? This was back in September when we had the big drubbing. The Coppock was down to -3. My gut feeling is, okay, the reason the Coppock hasn't come down yet and turned up on the daily, and this is a much longer swing indicator. This is not for trading, just so you know that, all right? Is because we're going to see the market, I think, in my opinion, in the first couple of days of November fall pretty hard because of elections. And that is where we get a sizable tradable bottom in the market. That's my opinion. And that's when I get my, that's where I get my 2070, 2080 SPX type of moves. I mean, pullbacks. Now let's take a look at the shorter term. This is 1 hour. So let's look at the 1 hour, which we use pretty nicely. This was your lows from the 13th on Friday. I'm sorry, this was Thursday. The big move up, then the pullback. It's like a consolidation flag, inverse head and shoulder, whatever you call it. And so we are seeing this. So on a short-term basis, the Coppock will get overbought. And I don't want people to track this. This is a little bit too much, all right? Will get overbought once it hits in this zone here. So on a shorter-term basis, it's I'm looking at the 2 hour here. So you see what's going on, okay? So the Coppock is over saying on the shorter term, we're going to get a tactical bounce, and then we're going to give in. Same thing with the 2 hour. I use the 2 hour a bit too, quite a bit too. So the 2 hour upper Bollinger is up here. So the 2 hour is also signifying we're going to get a short-term relief move, which will fall exactly where I'm saying where it will fall. This is moving fast. The crossover is about to happen, I believe, on Monday. Look at that. Very seldom does the negative vortex indicator comes down and then shoots up again. It'll cross down first before it makes a move up. So looking at this here, this is where I would say we get a max move short term, 2152. 2152, 2148. Short term, like this kind of like intraday type of stuff. I explained in one of my charts, we're going to go through this volatility period before we move higher, and I think that's exactly what's going to happen. What is the other one? Oh yeah, the other one that I want to show is the final chart is good old Thinkorswim. This is more Star Trek stuff, and this is where we are. Upper end of the Bollinger is 21. I'm sorry, the Darvas box on the daily is 2190. Let me just put up the SPX. This is the daily SPX. This is your big fat channel that the market's traveling in. If somebody wants, this is what's going to happen. It's going to come and try to retest this, fail. We are going to fall below 2100 in my opinion. And if we fall below that, obviously we've got other levels to cover. But this is a pretty defined chart in my eyes, what I'm seeing. These are the points of major resistance on the daily. The SPX daily is around 2165. We have a massive hammer reversal here, which I expected to be down here. I was wrong. You know why? Because everybody was expecting it to be down here. Everybody and their grandmas were going for 2100 and 2090. When everyone's watching the same pot, it never boils. That's the reason why the algos did what they did. It's a fact. In the old days, we would have tested 2100 bar none. But we never really got there on an intraday basis. We kept the September lows, which was a very powerful low. And remember this time, this was a very crucial time for the markets too. It also happens to be that multi-year breakout line, right? That I showed many times. And this one is telling me that this is the most that we probably get out of it. It's good money. It's good money. And this, one second. So that's it, you know. So this is your short-term picture. Oh, let me show you the short-term 1 hour on the short-term 1 hour was this. And this brings me to a point, a valid point. Jules mentioned this, and some other people mentioned it too, like, you know, the end of the day, like it didn't look good because there was all this selling and stuff. I give a lot less weighting to what happens at the end of the day because it means nothing what's going to happen the following morning or the following trading day. There are so many factors at work. It was Friday OPEX weekly. It was the week before monthly options expiration. There were resettings going on. It happened to be a big, fat, volatile week where institutional and retail margin calls needed to be settled. So despite this move here, we were up by 1 o'clock, we were up to 2142. And of course, these moving averages are acting as resistance. At 10 o'clock, we were at 2150. But here, at the end of the day, we were down here. Look what happened to the 1 hour. It got nicely oversold. And so did my quad algo HFT. I wanted the market to close lower at the end of the day so that the resets would be done before and not close at the highs of the day, because then they would, then from a technical standpoint, it would be selling again, overbought conditions. I want things to be in oversold conditions before Monday or at or before Monday's open. So I would actually want futures to be down tonight. That's, you know, you got to think outside the box. You don't want markets to open up. I mean, I would like to open up 100, 200 points if you're not positioned right. I'm positioned somewhat right with some SPX calls and a couple of other selective tactical longs that I've mentioned out to, you know, it's all posted out there. So it's great. But then at the same time, at the end of Friday, what we're talking about, this after a volatile, tough week, look what the Bollingers are. I've never seen a I mean, sorry, the Darvas box is like, where is the Darvas? This is it's like right there. So yes, we could bump down a little bit more. In fact, the futures can open down as long as the futures do their dance and remain down here. Okay, let me switch to the futures chart. Sunday after 6 p.m. that's when futures start trading. Look where we are. I want things to be down here when we open on Monday. That's when you get that nice powerful bounce. Now, saying all that, is it possible that we create another double bottom down here? Absolutely. Absolutely, it's possible. And I'm ready for it. That's where you cost average down. Can we short this move down? Yeah, if you're fast enough, you can do it. But I think, I mean, this would be very powerful. This would be very powerful. This would set up for a power move, in my opinion, up towards the 2126 level, 2160 level. This is when it gets exciting to buy things. Or we can basically move from here, maybe slip down a little bit, maybe do the resets pre-market. On, you know, resets are happening pre-market too in Globex futures. So guys, I don't want to go technicals anymore. Let me just put it this way. You guys really have to think outside the box. No one wants anyone to become a rocket scientist. I'm not. I see things the way it's worked. This is a head. This is a left shoulder. This is a right shoulder. I've shown multiple charts today. Multiple charts showing how oversold we are, what's going on in this and that, what the possibility could be if there is another black swan event and we could fall. We could get a series of Chinese data, or there's a lot of stuff going on next week. I put out the article out there so you can see, you know, Fed speakers, all kinds of stuff. Mario Draghi actually is on Monday. So we'll get volatility. But guys, you just got to do what you got to do, all right? No one's going to hold your hand and guide you through the market because they can't. But I've shown you all the possibilities of what's going on. And there are a multitude of opportunities to make money. I gave a 7-point mover. What's 7? Almost an $8 mover on Buffalo Wild Wing. I will state the point. And I probably had 3 or 4 people involved in it. It's just incredible. Apple's making, Apple calls, they're cheap. They keep on going higher. Samsung's finished. For now, it's finished. You couldn't ask for a lottery ticket better than this if you're Apple. You know what Samsung's selling their new Galaxy phones? They're giving you these oven mitts, so you can hold them. Okay, it's a bad joke. Seriously. They're giving you these big fat oven mitts. Like, okay, you got to hold them. That's how you hold the phone. So you got to talk with it with a flame retardant glove on. I mean, seriously. I don't care. Samsung's, as I like to call it, is off the table right now. Netflix is coming out on Monday. Everyone's just scared. Okay, that's fine. My charts are showing this. I have a bunch of calls, and I'll see what I can do with it. I think the stock is good for 8 pointer. So go ahead. Yeah.
Hey, Clue, can you do IBB? It's really got nailed. Just what your thoughts this coming week.
I'm telling you, this IBB is acting so. I mean, it's not just. It's not just the Clinton thing. It's just like the FDA is approving this and approving that, and so here is the IBB chart right now. Is so oversold. So let me give you the technical explanation on that, Corey. Okay. You got a situation here from a chart pattern standpoint, it's not good. And that's why I'm playing selective. I like those small ones that I keep on buying and trading. All right. So from a standpoint of the bigger IBB players, which are part of the biotech index, right? If you look at this pattern here, obviously that's a double top. And now it's down here. So a simplistic explanation, a simplistic visual will say, okay, IBB at this point will come and retest its multi-year type of lows, which is 240. That's from a chart pattern perspective, the old-fashioned way of looking at it. You follow me so far, Corey?
Yes.
Okay, I haven't finished. It's just the beginning. That's why you say everyone has to think outside the box. That's the old-fashioned way of looking at it. Here is the way I look at it. You got the IBB at the bottom end of the Darvas box, right here. You got a standard deviation here, which is at least -2 or -3, as in the distance from the 50 and the 34 and the 50-day moving average. You got the IBB on a daily basis. This is daily. Way oversold. Can't go any lower. Can't go lower. Okay, the internals, the lowest it gets to is like -1. We're there. We're there. You got, despite this fall on the, and let me draw this out. Let's just say this is the, okay. Despite this move down on a daily basis, the internal histograms are starting to curl up. First signs of a positive divergence in play. Just the way when the IBB fell here too and then started to rise, a similar type of pattern is developing here. On a short-term basis, the biotech index is way out of whack. On a longer-term basis, I have no idea, because it's just, they were heavy selling these 2 days. I bet you, and this has a lot to do with technical factors, which has nothing to do with fundamental stuff, okay, is that when you get these large blow-ups on smaller funds and stuff, maybe somebody had a big chunk of these biotech stocks that got, blown out of the water. You also had companies like Illumina, which lost 26% of its value overnight. I mean, talk about fear. So obviously the IBB is going to get hurt. This is where I'm seeing the support. 1 second. But I'm not playing the big ones right now. I have a bunch of cheap calls in Illumina. You don't hear, I'm just sticking to the ones which are holding and actually doing very well in difficult markets, the PTCTs and the Clovis and those ones. So saying all that, this is your support level. Right there. That was also the breakout level back on July 1st on that big move up. So now it's given back the whole thing. Do I think that IBB is going to fall below 260, 262? I don't think so over the short term. I think the more tactical move is it's going to pull a little bit back and then it's going to bounce. If it fails here, that means the channel is going to keep on crawling down. This will happen over weeks, not over days. But this, in order for it to test 240, something really dramatically crappy has to happen. So IBB is very deep oversold. Expect a tactical bounce, and you have to be selective on the stocks. That's the truth. If you're sitting on stocks with, and Corey, you don't need to tell me what stocks you own, okay? But I can feel that you're sitting on some big IBB stocks, which are basically you're bleeding money. So dump them. You keep on doing the same thing. And again, I'm not going to tell people what to do, seriously. I know I get passionate and stuff, but honestly, you got a losing position, freaking dump it, make it money elsewhere. Who cares? I don't, because I do that all the time. The net goal is your P&L going, is your account growing or not growing? So you're going to sit on a bleeding stock, which is not moving anywhere, you're down on it. My opinion is, slice out the position, not the whole thing maybe, because you don't know. These things can turn around. Either this Allergan is like a monkey on a hot tin roof. One day up 4, one day down 5, one day up 5. It's like, chart patterns weak on a swing basis. It's moving in between levels. So remember, human beings are stubborn beasts. And their stubbornness keeps them in the doghouse. I've felt it. I have done it. I know it. So it's up to each of you to do what you need to do. But generally speaking, and read all these other trading blogs and stuff, traders who've been trading for 50 years, they always say one thing. Keep on nursing your losing position. Your brain is, mush. You're losing money because you're not making money elsewhere. And you basically eventually burn yourself out. End of story. I'll take one or two other questions. And because I got stuff to do with the kid and the wife, and like I said, I've explained pretty much. It was a very comprehensive report. I will upload that either. I'll try to upload that before I leave, but if not, it's going to be later in the day. But I'm ready for battle. I'm ready for battle. I really appreciate, I mean that, all of you guys participating. We have had 2 or 3 people who just couldn't handle the heat drop off, and I don't blame them. It always happens. You get a big influx of people when things are just rocketing higher. So every single metric that I'm seeing from an emotional and a technical standpoint, short term, is depressing. And that is the point of tactical bounces. Saying all that, it's the last week of October. We have passed the middle of the October, which is the heaviest intense volatility. So I do believe that as we get closer to the monthly options expiration on August 21st, we are going to basically have, it generally has been proven right, 80% probability that we will end up higher for the week. But the last couple of days in October, second eve, now that we have the elections coming, might not be as conducive for a positive market. Just letting you know, because I think there's going to be a lot of nervous retail selling, which will cause large mutual funds and stuff to draw down on their stock positions and keep cash on the side. Remember, mutual funds always have to have redemption cash ready just in case, somebody says, hey, listen, people don't call up the mutual funds and say, oh, sell me on my money. No, they don't do that. They call up and say, let me get out of that growth fund and let me sit on the money market fund till the cloud clears. The famous last words, the worst words for a trader or investor. when the cloud clears, it's going to be way up there. IBB is going to be back at 300 again. You got to buy the silver lining peeking in between the dark clouds. It's always the case. With that statement, I wish you guys a great rest of the weekend. Stay focused. Stay strong. It's been difficult. I know that. I know it personally. But we have had some powerful winners, and I believe me when I tell you, one or two powerful earnings winners with a limited amount of money can take your pains away better than a triple dose of Tylenol, okay, or whatever. So that's with that statement. Have a great evening, and I'll see you guys tomorrow. And I will put this up, uploaded on the YouTube channel. See you guys tomorrow. Thank you for listening.